In early 2026, President Trump publicly told Americans to go out and buy stocks. For most people, that sounded like political noise, but for serious investors, it was a massive signal. Presidents do not make statements like that unless something much bigger is happening behind the scenes. If you want to understand how money actually moves before it hits the headlines, hit like, subscribe, and comment stocks below. Why 2026 is different from every other year. Every year brings market predictions, but 2026 is different because it sits at the center of several powerful forces. Artificial intelligence is exploding, government policy is shifting, and the Federal Reserve is changing how money moves through the economy. When these three things align, investment opportunities are created at a speed most people cannot keep up with. What makes this moment especially important is that Washington is no longer pretending to be neutral. The government is openly encouraging growth, stimulus, and market expansion. When leaders promise economic booms, it is not just optimism, it is a declaration of intent. The economy is not being left to chance, it is being actively managed. And when an economy is managed this aggressively, money always flows toward assets. That is why this year matters far more than most people realize. The interest rate lever. Interest rates are the most powerful tool in the financial system. When rates fall, borrowing becomes cheap. When borrowing becomes cheap, money floods into assets. President Trump has been pushing for dramatically lower interest rates, including changes at the Federal Reserve once leadership turns over in 2026. The goal is simple: make it easier for banks, hedge funds, and large investors to borrow money. When institutions can borrow cheaply, they do not put that money into savings. They put it into stocks, real estate, and financial assets. That creates demand, and demand pushes prices higher. Even if regular people do not see lower loan rates immediately, Wall Street will. And Wall Street is where trillions of dollars are moved every day. Lower rates do not just boost housing, they fuel the stock market itself. Government stimulus is not what you think. When people hear the word stimulus, they imagine checks in the mail. But the most powerful stimulus is not given to consumers. It is given to markets. Government policies decide which industries grow and which ones struggle. In 2026, those policies are shifting toward AI, data centers, rare earth minerals, and advanced manufacturing. The government is not only changing the rules, it is also investing directly in companies connected to those industries. That means public money is being funneled into private stocks. When that happens, investors who follow those flows often benefit. This is not about fairness. It is about understanding how power and capital work together. If the government is spending billions supporting certain industries, those industries usually grow. And when industries grow, their stock prices tend to follow. Money printing and who really benefits inflation is often blamed for rising prices, but it quietly transfers wealth. When more money is printed, everything costs more. Consumers pay higher prices, but businesses collect more revenue, and investors own the businesses. That means inflation sends money from workers and consumers into the hands of shareholders. The Federal Reserve has already ended its attempt to remove money from the system. It has begun injecting billions back into the economy. That process is expected to continue through 2026. More money means higher prices, and higher prices mean higher corporate profits. Those profits flow into stock prices. This is why investors often benefit during inflationary periods while workers struggle. The system is designed to reward capital. That is why being an investor matters more than ever. Deficit spending is fueling the market. The largest spender in the U.S. economy is not consumers or corporations. It is the federal government. In 2026, Washington is expected to spend roughly $2 trillion more than it collects in taxes. That extra money has to come from somewhere, and it enters the economy as stimulus. When the government spends, companies get contracts, workers get paid, and businesses generate profits. Those profits belong to shareholders. Deficit spending is like pouring gasoline on economic activity. It may not be sustainable forever, but while it is happening, it pushes asset prices higher. Stocks benefit directly because government money flows into the private sector. The more the government spends, the more revenue corporations collect. That makes deficit spending one of the most powerful drivers of the market, even when it creates long-term risks. The debt machine. Behind the scenes, every dollar the government spends beyond its income becomes debt. Sometimes foreign governments buy it, but increasingly, the Federal Reserve fills the gap. When private buyers are not interested, the Fed prints money and lends it to the government. This prevents default and keeps the system running. But it also injects fresh money into the economy. That money flows into banks, markets, and financial assets. The result is a cycle where government spending is backed by money creation. That cycle supports the stock market because it prevents major collapses in liquidity. When investors know the Fed will step in, they are more willing to take risks. That is why markets have become so resilient, even during periods of economic stress. Why markets are being backstopped. The U.S. stock market is no longer allowed to fail the way it used to. It has become too important. Pensions, retirement accounts, banks, and government finances all depend on rising asset prices. If markets collapse, the entire system feels it. That is why both the government and the Federal Reserve now act as a safety net. When trouble appears, money is injected, rates are cut, and support is provided. This does not eliminate crashes, but it changes their scale and duration. Investors understand this. They know that the system is designed to protect capital. That knowledge changes behavior. It encourages buying dips instead of panicking, and it reinforces the idea that being invested is safer than being left behind. How smart investors position themselves. Smart investors do not fight the system. They follow it. When the government changes policies, supports industries, and injects money into markets, those actions create signals. Broad market funds like the S&P 500 capture overall growth. More targeted investments follow government-favored sectors like AI, data centers, energy, and rare earth minerals. The goal is not to gamble. It is to align with where money is being directed. When public dollars and private capital move together, prices usually rise. That is why understanding policy, spending, and money printing matters. It tells you where demand is being created, and demand is what drives returns. Why following government money beats guessing. Most investors lose money because they try to predict the future. Smart investors do something much simpler. They follow where money's already going. In 2026, the largest and most powerful spender in the economy is not hedge funds or billionaires. It is the U.S. government. When Washington changes laws, offers incentives, and invests directly into certain industries, it creates guaranteed demand. That demand flows into corporate profits and then into stock prices. This is why sectors like rare earth minerals, AI infrastructure, energy, and defense keep attracting capital. These are not guesses. They are political and financial priorities. Following government money is like following gravity. You do not need to like it. You only need to understand it. The people who align with these flows get lifted while others struggle to keep up. The investor is now the system's priority. The modern economy is no longer designed primarily for workers or savers. It is designed for investors. Inflation pushes prices higher. Higher prices increase corporate profits. Profits raise stock values. Meanwhile, wages struggle to keep up. This means that owning assets has become more important than working harder. Governments know this. Central banks know this. That is why every major policy decision now supports asset prices. When trouble appears, money is printed. When growth slows, stimulus is injected. When markets wobble, support arrives. This does not mean risk disappears, but it means the system is built to protect capital. Understanding this gives you power. You can either be the one losing purchasing power or the one benefiting from it. In 2026, the difference is everything. If you want to stay ahead of where money is moving, subscribe, share this video with someone who needs it, and comment below which part of this system surprised you most. Because in 2026, the people who understand how money flows debt, that debt must be financed. Sometimes investors buy it,